Welcome to TheoTrade. This is Don Kaufman. Here we are. It's June 19th, 2017. Let's get right into it here as we've got about 3 minutes left in the trading session with the S&Ps exploding up to 2450 on the button, up 19 handles right now. And the Nasdaq futures up 1.6%. You got to understand, this is the type of opportunity that we are and have been looking for. In fact, I even discussed this specifically on the weekend kind of video. Was you had to wait. If you really wanted to look for opportunity inside of Apple, you had to wait for this kind of wild bounce to the upside. Ironically, you actually see me working an order right now into the close, and I'm going to explain exactly what that trade is. So in this kind of, evening update, I'm going to talk about how to exploit a couple of opportunities that I see right here, right now, that you can create as long as we're relatively stable to tomorrow's open, that you can create and kind of duplicate some of these opportunities over here. Let's start with a discussion on the S&Ps and why it's so important to have the discussion on the S&Ps and start over there. First and foremost, the most important product on your screen, mostly at any time. And again, people might say my risk is here, my risk is there. Yeah, but ultimately the most important product in the marketplace, it's the S&P, because that's really what's driving order flow amongst really any of the products that you happen to look at. And if you take a look specifically at the SPX, and again, I talked about this on the weekend video, and I hope you guys have the time to kind of tune in from time to time on that, and I'll explain exactly what the opportunity and what the trade happens to be in here. First and foremost, what you're looking at and what these lines represent on the screen, this is exactly where we ultimately started, okay, and ended last week. So last week, the S&Ps end right around this 2433 level. The expected move for the week was about plus or minus $21. Now why is that incredibly important? This line, okay, I didn't just draw this on the screen right now. That was there, and that line represents all the way up to 454. The irony is we literally touch the expected move, stop on a dime, and pull back inside of it. Okay, so why this is so incredibly important? This is the expected move all the way out till Friday, and we've now hit it plus $21, literally inside of one trading session. I've got to show this even on an intraday position, because really how much you need to expect. I mean, this is not some like crazy Fibonacci. All we're doing is translating option pricing into, okay, the expected move. Ultimately, we touch the expected move, we revert back down off of it. So now there's really only two scenarios here. And what are the two scenarios? Can we go above the expected move? Now let's think about this, okay? In almost any recent week, we have had a few recent weeks where we just clipped outside of the expected move for a brief and fleeting moment, okay? We've had some expected moves get cracked to the downside, only to see the markets rally right back up in it. But we've only had a handful of occurrences, literally a handful, there's the closing bell, a handful of occurrences in recent market history, okay, where we breached the expected move substantially. And it's something that you have to really recognize right up front over here, because this happens to be 16 weeks of data that you're looking at, and in no instance did we, okay, substantially breach the expected move. The last time that we breached the expected move in a substantial way was all the way back on December 7th. That was a 3 sigma move. That's a 3 standard deviation move. So bear with me on this one, okay? You want an opportunity? Here's the opportunity. Number one, the SPX is already up 20 points. If we're going to fully breach the expected move to the upside, and I'm not here to tell you, come on, nobody has any idea. We're going up or going down? Yes. I'm not here to tell you, that we're going up, going down, but I can tell you a fantastic opportunity that isn't going to really cost you very much to trade it. If you believe that we can actually crack the expected move, well, if we're going to go for it and we're going to make what we kind of call a 3 sigma move. That's 3 times the the standard deviation. Well, the standard deviation, okay, was plus 21, so 3 times the standard deviation. I mean, you're looking at over a $60 move. Okay, that would be a $60 move. So what kind of a trade could you do to harness a $60 move? That would be between now and Friday. Could we move up another 40 points? The answer is absolutely. For that, I'm going to go over to the spiders, and I'm actually going to show you the type of trade. You know why? Because I'm doing it, all right? And I've put it on a multitude of times over here. Now, I've got a lot of different positions that I'm running right now in the spiders, okay? But I will show you precisely what I have been working in here, and you can see I've been hard at work right now. Okay, canceling, replacing, cancel, replacing a number of orders. That's what it takes to get filled at good prices. But I'm going to come in here now. I'm going to create a duplicate order. I'm going to show you exactly what I've been filling. All right. And I'm also going to take this over here and I'm going to just show you one contract. I'm going to just analyze the trade with everybody so that we're all ultimately on the exact same page. Okay. What we're looking at in this particular circumstance, it's a ratio back spread. And what the ratio back spread is doing is I am selling one of the 245 calls, okay, selling one of the 245 calls and buying 3 of the 246 calls. It's actually done for an 8-cent debit. Now, if I unlock the lock, the closing price was 10 cents, okay? The closing price of this trade was 10 cents. Nevertheless, I was able to fill, I think 4 or 5 of them right in that neighborhood there of about 8 cents. So I'll revert back to the 8 cents because that's right around what I want to pay for it. So I am paying 8 cents, but I also have risk in this trade. I don't want you to believe that there's no risk. Okay, there's a little bit more risk right here in the neighborhood, again, of about what? 246. So there's a little bit of what we call a valley of death. But then if we explode higher, okay, there's nothing but profitability out there. So it's a very shallow amount of risk that exists inside, okay, of this ratio back spread. So I'm selling 1 to be able to buy 3, and it almost finances itself, okay? And so what's the point of this? If the market ultimately explodes higher, now exploding higher, what would I need? Okay, now we just talked about, could the market move 40 points higher? 40 points higher on the SPX would be the equivalency of about 4 points higher here inside of the spiders. Okay, that would take us from 244 and change all the way up to 248 and change. And this trade, this is one contract, would be a home run. One contract, okay, could make us in excess of $400. So I went out there and I loaded up at a couple of these trades. Again, it's a 1/3 ratio back spread, and it's only good for this week. I'm not getting cute. I'm not going far out in time over here. All I'm looking for, okay, is again, if you look at some of the data that I've run in the SPX, okay, in the most recent, again, the most recent period, more often than not, we close inside the expected move, okay? But if we're going to make this wild move outside of it, we're going to do a 3 sigma move, which is just an explosion 3 times above and beyond, okay? And that's the right trade ultimately to have on. So that is one scenario for it. And I'll tell you what, if I'm wrong, who cares? What am I going to do? Am I going to lose 8 cents? Oh, but still my heart. I'm going to lose 8 cents. Okay. If I'm totally and completely wrong, and I'll go back to the spiders for just a second and elaborate upon this, but if I'm completely and utterly wrong and the market turns around and sells off, I have nothing more than 8 cents, okay, per contract at risk. And I think that that's a decent kind of risk reward. And again, you can see this is how I build quote unquote inventory in the spiders over here. And I have, okay, a fairly substantial inventory of different option trades that are rolling into the spiders. Again, that 1/3, make it very, very clear once again so that everybody understands. I am selling one of the 245s, buying 3 of the 246s. It is in the June 23rd expiration. The next trade I would look for, okay, quite simply put, I did not fill on this one. I'm going to try again in the morning. I'm looking for a short position in Apple. I talked about Apple quite a bit in the weekend video, and Apple is down on the hole. And one of the exact things I said, don't short into the hole. Wait for the bounce. We got the bounce. The question is there going to be follow through? If there's follow through to the upside in Apple, you do realize that I just put on the spider trade. So I can actually short Apple really without consequence, because if I'm wrong in Apple and I'm going to short Apple tomorrow and I'm going to use a defined risk trade, because I'm scared that, Apple, come on, if this thing gets its legs under it, it's going back up to 152. I don't want to get in the way of Apple. So what I'm going to do is I am going to put a defined risk position into Apple. I'm going to use, the July 14th, and I'm probably going to do this 148, and then you can see I was actually working it over here, but I'll just duplicate the order. The 148, 146, and I'm trying to fill this right around 99 cents to $1. Okay, all I want to be able to do is buy the put spread. Now, even if I buy the put spread tomorrow morning and I'm wrong and the market explodes higher, that's okay, because my spider trade then is likely to work. So I'm actually using the Apple trade and the spider trade ultimately against one another in this particular circumstance. If the market then falls, if Apple falls, I'll be profitable because the position in Apple is bearish. And what do I lose in the spiders? A whopping 8 cents. Okay, there's another one I just filled again at 8 cents. So you can see even a few minutes after the market closes, the spiders are open 15 minutes after the close. So there's some opportunities right here and right now that you have to consider with a marketplace that got fairly hot. Now, at this point in the game, I'm just going to tell you, this is more of opinion, than it is definitive trading. The trades I gave you, are outside of opinion. The trades and the trade logic has to resonate even if I'm going to be wrong. My opinion is, at this point, this is just a bounce. This is actually a bounce in the Nasdaq. I think tomorrow we could even open a little bit higher and then come off hard and fast. And that's what I would expect, given the fact that the S&Ps, the moment these S&Ps approached that expected move, they backed off fast off that expected move. So consider it a kind of a warning shot. This is a lot of times what bearish moves look like. And people, that just doesn't really resonate with them because they haven't seen a bearish move. But what bearish moves look like, the up days, are vicious, unrelenting, what they call rip your face off rallies. And this has all the hallmarks of it. Stay tuned, much more to come here at TheoTrade. Have a great evening, everybody. Bye-bye.